This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Hello and welcome back to Season 2 of Tax Records, our podcasts looking at the latest hot topics in the tax world. This season, we'll be discussing the long-awaited guidance to Section 100A. We'll also be looking at the issues associated with businesses engaging contractors and recent ATO guidelines around the structuring of professional practices. So in this season, there is something for everyone. My name is Frank Hinopoulos and I'm a partner in the tax team at Hall & Wilcox. Today, I'm pleased to be joined by my colleague Todd Bromwich, a senior associate in our tax team. And we're going to discuss Section 100A of the Income Tax Assessment Act 1936. And as part of that, we're going to look at the recent federal court decision in the Guardian AIT case, as well as some administrative guidance materials that have very recently been released by the ATO.
Hi, Frank. Thanks. It's good to be back for Season 2 of Tax Records. I'm glad Season 1 performance passed muster and Spotify didn't ban us from the airwaves. It's great to be here to discuss Section 100A with you. It's a tricky little section that's been around for a long time, but it's still poorly understood, and I think a lot of practitioners have never even heard of it. So to kick this off, could you just give our listeners a quick overview of what Section 100A is and why it was introduced?
Thanks, Todd. Well, Section 100A has a long history. It was introduced in 1979, although I don't think that makes it too old, because 1979 is also the year that I was born. Like a lot of provisions that were brought out then, Section 100A was an anti-avoidance provision that had been designed to target especially egregious trust stripping arrangements that were, at that time and at that place, unfortunately very prevalent in the market. Not that I can remember any of that, because I certainly wasn't practicing tax as an infant. Now, of course, we see this with 100A, and we see it with other provisions like Section 99B as well. And it may have been introduced at a particular time and in a particular context, and it may have had a particular anti-avoidance provision that was informed by that time and by that context. But its actual application, technically, and its application on its words, can be a lot broader than those particular circumstances that existed at the time that they came in, that the provisions were introduced.
Okay, so Frank, at a basic level, what does Section 100A actually provide for?
So, Todd, Section 100A provides that if a beneficiary is presently entitled to a share of the income of a trust estate, and that present entitlement arose out of a reimbursement agreement, then the beneficiary is actually deemed to not be presently entitled to that share of the trust's income. So Section 100A attacks present entitlement in respect of income of a trust. Now, the key question there is, what's a reimbursement agreement? And a reimbursement agreement, in broad terms, is an agreement providing for the provision of money, property, services, or other benefits from a trust to a person who is not the relevant beneficiary that's been made presently entitled to a distribution of the trust's income. In circumstances where that arrangement or that agreement has been entered into for the purpose of ensuring that somebody pays less tax than they otherwise would have, but all subject to, and we'll explore this a little later on in this podcast, all subject to a very important exclusion, and that is the exclusion that applies to an arrangement entered into in the course of an ordinary family or commercial dealing.
Okay, so if Section 100A applies, what's the practical effect of that? What happens?
So, Todd, as I said, if Section 100A applies, then, and I might make the point that it is a self-executing provision, so it doesn't need the commissioner to decide or to determine that it applies. But if it does apply, then it attacks the present entitlement present entitlement a trustee has created to trust income. So by attacking the present entitlement and invalidating the present entitlement, the way that the tax assessment rules operate normally, it means that the trustee will be assessed at the highest marginal tax rate plus the Medicare levy, which effectively is around 47% on the amount of the trust distribution. The other point as well, and this is a bit of a sting when it comes to Section 100A, is that it is one of the few provisions that has that is outside of the application of the assessment limitation rules. So somebody may be assessed under Section 100A, or a trustee may be assessed under Section 100A indefinitely. Not 4 years, as is the case with a normal assessment, or even 6 years, which is the case with Part 4A, but possibly indefinitely.
That's a pretty significant consequence, Frank. And many of our listeners, our clients and their advisors, their trust deeds might contain a default distribution clause. So if Section 100A attacks and invalidates a beneficiary's present entitlement, does the default distribution clause kick in?
Sure, Todd. I mean, just to take a step back for a moment, in case anyone's not familiar with that particular terminology, a default distribution clause generally provides that if the trustee fails to confer a present entitlement to part of its trust income for a year to a beneficiary of the trust, then the income is automatically deemed to be distributed or deemed to be presently entitled in favour of a particular beneficiary or beneficiaries. So it's almost a backstop should the trustee either intentionally or unintentionally not create a present entitlement under the terms of the trustee. Now, back to your question, the short answer to that is no. The courts have said that where Section 100A applies to an amount of trust income, the effect is that the effect of any default or automatic distribution of that income is also disregarded, such that the income will always be assessed to the trustee.
We've been hearing a bit about Section 100A in recent years. There's been a bit of uptick in discussion about it. Why do you think that is?
Sure. I mean, we have referred to Section 100A as having undergone or experienced a bit of a renaissance from the perspective of the ATO. And I think there are a couple of reasons for that, Todd. One reason is that the ATO has been looking at trusts and arrangements involving trusts more broadly, and we address some of these compliance target focus areas in our previous podcast last season. So, the ATO has the resources and has the people and has the technical capacity now to look at more issues concerning trusts, and 100A as a trust anti-avoidance provision is well and truly in the mix.
Okay, so you mentioned before that there was some recent administrative guidance. What do we actually have now, and why do you think the Commissioner is acting now?
So, Todd, what we have now is two key and important pieces of guidance from the ATO. One is draft tax ruling TR 2022 draft 1, or D1, and draft practical compliance guideline PCG 2022 draft 1, or D1. So the tax ruling sets out the Commissioner's views on the scope and application of Section 100A, and in particular concentrates on what constitutes a reimbursement agreement and when the ordinary family or commercial dealing might apply. The practical compliance guideline, and we've seen a few of these kind of documents being released by the Commissioner on a few different areas where there is significant technical uncertainty and compliance risk. But the guidelines here provide a statement of how the Commissioner intends to apply compliance resources in reviewing arrangements which involve trusts from the perspective of Section 100A. And The other part of your question, Todd, is why has the commissioner acted now? I don't know for sure, and we don't know for a fact, but I would imagine that there has been quite a call for clarity on Section 100A and the ATO's compliance approach and attitude towards it from the profession. And there are a number of matters which are the subject of active review and audit, and some of those matters we're involved in, which have brought up issues around Section 100A. And there has been, I think, for some time, a focus on the ATO settling on its house view, so to speak, and providing some clarity about that to the market.
Okay, so Frank, on that first piece of guidance material you mentioned, the tax ruling, which provides the Commissioner's view on the application of the law, does that provide anything that we don't know already?
Well, yes and no, Todd. And I think what we have to keep in mind, and always keep in mind, is that tax rulings are really a statement of the Commissioner's opinion or view of the law. I mean, it is not the law, and they do not have legal effect. But what they do provide is some insight about the Commissioner's attitude and his interpretive approach towards the law. And it's very important that we as advisors and as practitioners have some understanding of that and are incorporating that into the advice and risk-weighted decisions that we're helping our clients make.
Okay, so what are the key takeaways from this ruling?
Sure. So focusing on the ruling for the moment, the ruling itself focuses on a number of key points related to the reimbursement agreement concept. The first point, or the first principle that the ruling discusses, is that there must be a connection between the agreement and the present entitlement to trust income that the ATO has under review or is examining. The other point is that there has to be a benefit provided to another. So this is a really important point. I mean, a reimbursement agreement, at least in the ATO's conception of that term, arises where a present entitlement is created in favour of one party on the papers, so to speak, under the trust resolution, but the real financial benefit of that resolution is enjoyed or is implied, is applied to benefit another party. And that's not just money or a distribution in the sense that you would imagine. It actually extends to any application of the trust's property or resources. The third point and the third element of a reimbursement agreement, Todd, is that there has to be a tax reduction purpose. So this is where 100A brings in that sort of element or examination of a person's purpose. And we see that in tax quite a bit, whether it's Part 4A or elsewhere. One important thing that I think distinguishes Section 100A is that you have to note the deliberate use of the singular tense. It has to be a purpose of the taxpayer to achieve a tax benefit or a tax reduction. It doesn't have to be the only purpose or even the sole or the dominant purpose. And what happens in real life when people are planning their affairs, tax may be one thing that they are considering, but there may be a host of other objectives or practical considerations as well. For example, the need for asset protection or the need to grow a family pool of wealth or investments. So that purpose element here is going to be, in all of these questions, really, really important. And the final element that the ATO covers is the exclusion for ordinary family and or commercial dealings. And with respect to that, the Commissioner says that with some reference to the Guardian AIT decision of the Federal Court, that ordinary, at the risk of sounding trite or flippant about it, ordinary means ordinary. It is used in contrast to something which is extraordinary, where the circumstances are such that the course of action is not something that would occur in the usual course or not consistent with a purpose or a planning objective that doesn't involve tax.
Okay, so you mentioned the Guardian AIT case, and I know the Commissioner was unsuccessful in that one, pending appeal. In the ruling, has the Commissioner accepted the court's reasoning?
Well, Todd, and not surprisingly, being a decision of the federal court, yes, they have. The Commissioner accepts that the elements of a reimbursement agreement, all of the elements of a reimbursement agreement, must exist and be in place at a particular point in time. And importantly, that agreement has to pre-exist two things. The first being the present entitlement of a beneficiary to trust income. That being the present entitlement, of course, that the ATO will at the same time be looking to attack as being connected to a reimbursement agreement. And the second is the provision of a benefit to a person other than the beneficiary. So the court in Guardian AIT basically said that had to be preordained, that somebody other than the intended beneficiary or the beneficiary intended to benefit from the trustee's action in resolving to distribute or apply income in their favour, that the true financial benefit attributable to that would be enjoyed by a different party. That had to be preordained at the time the arrangement was created or entered into. Now, of course, the Commissioner does temper this by saying that these matters will be informed and the evidence will arise from the conduct of the parties, both before and in the lead up to, as well as after and in the aftermath of the relevant arrangements that have given rise to the establishment of an agreement at a particular time.
Well, it all sounds like a bit of a mess, to be honest, Frank, and it seems like it could be a bit of a nightmare practically for taxpayers and their advisors to navigate these issues day to day. Does the practical compliance guideline help us at all?
Well, the answer to that, Todd, is in some ways it does, and in many ways it doesn't. What the practical compliance guidelines do is it gives us some flags to swim between. And what the debate is all about is really whether where those flags are planted gives us a safety zone that is narrower than we thought, and that makes a lot of arrangements that have been vanilla and mainstream for a long time now suddenly more risky for our taxpayer clients.
So I've read the practical compliance guideline, and like many of them, like the ones we've seen in transfer pricing or GST, that they do break it down into the zones. We have the white zone, which is pre-1 July 2014 arrangements, which is, of course, around the time that the ATO published their online web guidance on 100A. And they say, they won't apply any compliance resources to review those historical arrangements. We have the green zone, which is your fairly safe vanilla arrangements, all above board, where the ATO says, we don't think that these arrangements are an issue. We have the blue zone, which is this purgatory no man's land, where the ATO says you might be looked at, you might be in trouble here, but we would have to look at all of the facts, all of the circumstances. And then we get up to the red zone, the danger zone, which is your fairly egregious ones, where the ATO confirms that if you enter into this type of arrangement, you will be reviewed, and you will be a target of ours. And of course, danger zone brings in considerations of Top Gun, which me and you, Frank, in the office, I got to say, I would be Maverick and you would have to be Goose. And I demand that a mustache comes in on Monday to confirm.
Well, I don't quite know about that, Todd, and I did. It didn't go unnoticed that you gave a title to our article based on your favourite '80s movie and soundtrack.
That's right. I've got a good 8 inches of height on him, so I'll settle on that.
But no, that was a very nice flourish. Nice try, but no, I'm Maverick and you're Goose. Anyway, we have certainly seen practical examples of arrangements that fall into all of those zones, including the red zone. And to give an example of that, We actually are running a matter for a taxpayer at the moment that involves this very fact pattern. And it is also the fact pattern that was addressed in the Guardian AIT decision. And that's called, or what's come to be known as the washing machine arrangement, where you have a trust that earns income, say in the form of franked dividends, and it distributes those amounts as a trust distribution to a corporate beneficiary, where the trustee is the sole shareholder of that corporate beneficiary. And then the corporate beneficiary effectively pays up those amounts to the trustee as a franked dividend. And this arrangement and flow of funds, trust distribution into the corporate beneficiary and a dividend out, repeats and recurs over a period of time. I mean, that's an arrangement that the Commissioner has identified here as being a red zone, arrangement. If that's what you have, you're certainly on the highway to the danger zone. But I think, as the Guardian AIT decision illustrates, as well as many other matters that are under review presently, that even an arrangement like that, despite what the ATO's reactive view about it may be, could be explicable by a number of different things and a number of considerations that would have that would be separate to and aside from any tax-related considerations, including considerations relating to asset protection or other things along that line.
It's interesting, Frank, that the ATO would put out these guidance materials while a court decision is pending appeal, and that's the Guardian AIT case, which is now heading to the full federal court. Is there any reason why that may be?
I mean, I agree with you, Todd. It was an interesting decision to put that out now, particularly when the Commissioner has appealed the Guardian AIT decision of the federal court when it was heard by a single judge. I mean, I think there's a fair amount of pragmatism and practicality in that decision. An appeal to the full federal court could take a long time to be heard and then to be determined, and there would be uncertainty about the outcome. And I don't know that the ATO necessarily wanted to continue or perpetuate the current uncertainty for that period of time. It also the fact that there are, in the practical world, a number of real life audits and real life taxpayers who are being affected by these, by the view on 100A, and there was some impetus on the ATO to try and get out its view, to make it publicly available, albeit in draft form and subject to further consultation, with some haste.
Okay, thanks, Frank. Well, just to round out today's discussion, do you have any practical advice that we can leave our listeners with?
Certainly, Todd, and as hopefully our listeners will know, we are practical people and we like to give practical advice. And just a couple of things that I wanted to leave people with today. Firstly, just to reiterate that since 2010, we've been hearing a lot about Section 100A. We've seen it in lots of reviews and lots of audits, and it has been an ATO focus area. And in particular now, with the practical compliance guidelines and the rulings, advisors, I mean, our professional colleagues who give tax advice are on notice that there are arrangements which will be considered to be high risk and which will be reviewed. So further unwanted attention from the ATO should be expected for those who have arrangements that would fit into the higher risk categories. The other thing as well is, having put this information into the public domain and put it into the hands of advisors, we certainly need to be, as advisors, aware of the need to be providing information to our clients when they're structuring their affairs, or even when they are continuing affairs that the arrangements or affairs that they currently have in place, to ensure that they are making appropriate and risk-weighted decisions. The ATO has been clear about the arrangements that it regards to be high risk, and if a taxpayer is or is contemplating a high risk arrangement, that's fine, that's up to them, but they need to be apprised of those risks and that situation, and that they may have a greater exposure to ATO scrutiny at some point in the future. And we as advisors need to ensure that we're arming our clients with that information. And if we don't, some advisors may have been found to have aggravated their clients' problems as opposed to assist in resolving them. And I think the final point I want to make, Todd, is and this comes from practical experience, is that Section 100A reviews and Section 100A audits are very much a forensic exercise. A lot depends on the facts, and we've spoken about that today. What is the evidence of the arrangement, and what is the evidence around when the arrangement came into being? What is the evidence about a taxpayer's purpose? And if you are, and I hope not too many of our listeners are, but if people are involved in an ATO audit that concerns Section 100A, you should expect the complexity to come not necessarily only from the legal and technical arguments that you have to make and debate with the ATO, but also that ATO fact-finding exercise. So, you should fully expect, for example, that your clients will be called in for formal interviews. The commissioner will exercise his information gathering powers to collect documents that may include advice from accountants that raises important questions about whether that can be in any way sheltered, either by professional privilege, which is available to lawyers, or the accountant's concession, which has significant limitations, and really, be prepared to have arguments, and a complex argument, based on the facts and based on the evidence.
Yeah, so there are still some unknowns with Section 100A, but we have the Guardian AIT appeal coming up, and we know of at least one other federal court proceeding in relation to Section 100A that we expect a decision on soon. So we hope that they will provide some additional judicial guidance. And we'll be writing about any developments on our website and on LinkedIn. And if the changes are significant, we may even provide an update in season 3 of Tax Records. So watch this space, and hopefully there will be some more guidance coming soon. But thanks, Frank, and thanks to all of you for tuning into today's episode. We hope you'll join us next week, where we'll be talking about the tax issues involved with engaging contractors in your business. If you have any questions about what we've covered today, please contact a member of our tax team. You can find our details on our website, hallandwilcox.com.au, or you can connect with us on LinkedIn. If you enjoyed today's episode, please rate, review, and follow our podcast wherever you listen to your podcasts. You can subscribe on our website to be notified of new episodes.